Thanks for clicking. The Canadian Real Estate Association, the CREA, just released Canada's national sales data for the month of May, showing a continual increase in sales and prices. Yet the increase in prices could very well prove to be short-lived, as the Bank of Canada's recent increase to the policy rate could no doubt put downward pressure on the real estate market. And in addition to the increase in interest rates, we also received news this week from OSFI, which could put more downward pressure on the real estate market, as the regulator is instructing the banks to address the risks being added to their books via mortgage extensions. However, thankfully, given this uncertainty, the CREA has released its assessment for the housing market and given its outlook for the market going forward.
Our forecasts and predictions, which, not to toot our own horn here, have been super accurate. So you and the rest of the CREA stats team do an excellent job at extrapolating the latest housing data.
What color is the sky in your world?
So what I want to do today is go over Canada's real estate data for the month of May, discuss some of the predictions coming out of the CREA, take a look at the instructions to the banks coming down from OSFI, and then take a look at how this could put more downward pressure on Canada's real estate prices. Many are predicting that the Bank of Canada is going to be raising interest rates again in July, but that decision will be largely based off the inflation data, which is due out in a couple of weeks. We'll obviously have updates out on that data on this channel. Click like and subscribe if you want to get those updates, but for now, let's get into May's data. On to May's data. First up, the average price. The average price of a home in Canada was up in May. The average price in April was sitting at $716,000, and that bumped up about $13,000 to $729,000 in May. And the benchmark price was also up a similar amount. The benchmark price, if you remember, that's the price of a home, which represents the most popular set of features. The benchmark price in April was sitting at $723,900, and that jumped up to $736,000 in May. So we have the average and the benchmark price up, both about $13,000 or $14,000. And the reason, says the CREA, is a lack of supply, as new listings, while still up 6.8% from the previous month, are still running at a historic low. And the reason, says the CREA, are interest rates, in that people don't want to move. Homeowners don't want to part with their historically low interest rates.
And I think it's in part, large part, the reluctance of those existing owners to take advantage of this market because they don't want to mess with the once-in-a-lifetime ultra-low fixed rates they locked in recent years. They want to hold on to those.
And I think there's some real truth to that. Homeowners who took out mortgages in 2020 and 2021 have a great rate right now if they took fixed. As we talked about before on this channel, a large portion of mortgages taken out during those 2 years were in fact variable. So about half of those borrowers to which Cathcart is referring don't actually have that great a rate right now. And of those mortgage holders who did take fixed, most banks, most mortgage lenders will allow them to port their mortgage. They'll allow them to take their mortgage rates with them, and if they need any new money, that money would be at the new rates, but they'll still get their old rate for their old money. So it's probably not just previously low interest rates that are keeping homeowners out of the market. Though, very briefly, it is somewhat surprising to see the CREA so focused on 2021 interest rates keeping homeowners out of the market, as throughout 2021 they were laser focused on the supply narrative, pushing supply as the reason for the price increases in January, February, March, April, May, June, July, August. You get the idea. September, October, November, December. In fact, throughout 2021, there was only 2 mentions of low interest rates in pushing up prices. Once in March of 2021, and again in December, when they were already pushing for regulators to loosen the stress tests in anticipation of higher rates.
Are you serious?
Coincidentally, this week, Stats Canada released a report showing that in 2021, in Toronto and Vancouver, supply actually outpaced population growth.
Not to toot our own horn here.
So, in summary, in May in Canada, the average and the benchmark price were both up due to a lack of listings, although new listings are coming to the market. With that said, it's not clear that this lack of listings can persist for much longer. This week, the Office of the Superintendent of Financial Institutions, OSFI, released a statement saying they had instructed the banks to promptly address mortgage extensions, specifically highlighting the risks of negative amortizations. And we've talked about negative amortizations on this channel before at great length, where holders of variable rate mortgages aren't paying enough to cover the interest portion that is due, and as such, that interest portion, that unpaid interest portion, is getting tacked on to the amount of their loan. So in most mortgages, as you make payments to the bank, the amount of money that you owed the bank actually decreases, in this case with negative amortizations, as time goes on, the amount owed to the bank is actually increasing.
Yeah, I'll try to help you, all right?
God bless you, Paulie. I appreciate it. God bless you. Always been fair with me.
And OSFI told Reuters this week that it has instructed the banks that they be active in managing all types of mortgage accounts, active in managing these variable rate mortgages with fixed payments. Meaning, I think, that OSFI is telling the banks they can't let this go on ad infinitum. This can't go on forever. The banks can't let these negative amortizations run into 30, 40, 50, 60 years. They have to address these payments. Now, that could mean asking borrowers to increase their payments. That could mean asking borrowers to make a lump sum payments to bring the amortization back down, either of which could force some borrowers to engage in anticipatory selling before they see their payments go up or before those lump sum payments are due. And this would obviously lead to a surge in new listings. And that's not even to mention, recall back in February when it came out that a poll in January found that 45% of all holders of variable rate mortgages would have to sell in 9 months if interest rates didn't come down. Taken at face value, that would put the sale date in September, just a few months from now, and the Bank of Canada has raised rates and is set to raise rates again since the timing of that poll. Now, this isn't to say that the banks are going to be forcing holders of variable rate mortgages to sell their homes en masse. This isn't to say that 45% of holders of adjustable rate mortgages are going to be selling their homes, but rather this is just to say that there is pressure building on the supply side of the market. There are these growing pressures on the real estate market sitting in the background of which we have yet to see the full effects. And with CIBC and others saying that we won't be seeing rate cuts until this point in time next year, it's not likely that this situation is getting better anytime soon for these holders of these variable rate mortgages. And as such, we could see more and more anticipatory selling going forward. With that said, how these rate hikes, how OSFI's directions will play out in the market remains to be seen. But we'll obviously continue to have updates out on Canada's real estate market on this channel. Click like and subscribe if you want to get those updates. But for now, thanks so much for watching.